Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another Your Tax-Free Life podcast. I'm always excited to be here with you each and every week. And I do appreciate the fact that many of you are listening to us on a regular basis. For those of you that are either listening to us or listening to us for the first time, I would appreciate if you can subscribe to the podcast. All you have to do, if you have a smartphone, just go into the podcast app and then query or search for Your Tax-Free Life, and I would appreciate your support. And also, if you like the content that we provide on a weekly basis, and you want to share and help us along those lines, and that would be greatly appreciated, because at the end of the day, we feel very strongly that information without education always leads to failure. So one of our goals in our podcast on a weekly basis is to give you not only information, but also give you the education that you need in order to be able to execute the different areas that you may want to improve on your financial life. Now, last week we finished a part 3 series on the IRS tax buckets, the taxable bucket, the tax-deferred bucket, and the tax-free bucket, and we did receive a lot of accolades from many of you along those lines, because at the end of the day, if you understand how to navigate the 3 tax buckets, then you're going to be in a much better position when it comes to your retirement distribution planning. This week, we're actually starting a part 4 series on the major risks that are going to be affecting all of you and all of us in the future and during retirement. And it's the risk of living too long, the risk of living with a disability, the risk of living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, and many of the other eroding factors that we will be covering at that point in time. And then last but not least, the risk of dying too soon and the impact that that would have on your family and on your business and so forth. So this is going to be a 4-part series that we're starting today. So we'll finish it 4 weeks from today. But today I want to start with the 4 ways to mitigate the risk of living too long, which is one of the biggest issues that all of us are going to be having to deal with at some point in time in the future. Now, whenever we engage clients here in our firm, and we do a lot of tax planning along those lines. But, what's really interesting to note is that every time that we engage clients or interview clients for the first time, it never ceases to amaze me that the vast majority of clients are either very close to retirement or entering retirement, have not done proper planning. They're looking at their retirement planning from a holistic standpoint, and they fail to understand all of the issues and concerns that they're going to have to be mitigating at some point in time in the future, and they're not prepared to do so. So in this podcast, I want to share some of those. And again, 4 ways that you and your family are going to be able to mitigate the risk of living too long, which is in many ways a good thing, a very good thing, but in other ways could be very, very detrimental to many of us on this podcast. The first thing that I think we all need to do is, to be able to understand the risk. Because if you're not able to understand the risk, then it's going to be very, very difficult to identify solutions that may help you either avoid and or eliminate or reduce that liability at some point in time in the future. So obviously inflation risk is one of the major things that we're all going to have to deal with. And again, inflation risk is part of the risk of dealing with eroding factors. So we're going to be spending more time, more quality time when we get to that episode. But at least for now, it is very important that you understand that one of the major risks of living too long is inflation risk. And let me put it to you this way. If you take a look at, $75,000 of income in retirement today, and let's use an inflation rate of 3%, although many a times, because of the fact that inflation is not tax deductible, inflation is much higher than 3%. And obviously the way that the government computes the CPI, they leave out some of the major issues that can negatively impact the inflation rate, like energy, gas prices, food, and so forth. But if we're taking a $75,000 of income today at an inflation rate of 3%, in 20 years from now, we would all need $135,458 to have the same purchasing power that $75,000 of income has today. So that's a major issue. That's one of the major issues that the vast majority of the clients that we engage for the first time don't think through, that inflation is going to be eating away at your purchasing power every single year, whether you want to or not. Now, for some of us, because of your propensity to consume, the inflation rate may be even higher because of the budgetary issues and concerns and your purchases and the quality of your purchases and so forth. Now, not only do we need $135,000 in change to be able to replace that $75,000 of income today, 20 years from now, but if you want to look at it from a different perspective, $75,000 20 years from now will only purchase $41,500 of goods and services today. So you can now see from two different worlds what the impact of inflation will be in the future, and what you need to do in order to make certain that you can mitigate that inflation liability, not only now, but for many, many years in the future until the day that you die. Second, tax risk. That's another issue that we need to be able to understand and mitigate. Tax risk, it's a major problem, because if inflation is going to deprive you from maintaining your purchasing power in retirement unless you do something about it, then tax risk is going to compound that problem. Now, we all understand where taxes are going to be in the future. They're going to have to be, a lot higher than they are today, because of the fact that, we are at the third lowest tax bracket in history, yet we have the largest amount of debt that we have ever had in the history of this country. So when you take a look at the national debt, which is sitting at almost $22 trillion, when you take a look at the unfunded liabilities for Social Security, Medicare Part D, and the interest on the national debt, and the compounding effect is at $115 trillion. And then obviously our national deficit, which is the difference between what we generate in revenues for the government on an annual basis versus what we pay out. In 2019, we're either at $1 trillion deficit or very close to it. So obviously there's no way that we're going to be able to survive without increasing that tax liability substantially at some point in time in the future. So that's important to note. Stock market volatility. That's another major risk and major issue you're going to have to deal with. And by the way, stock market volatility has a major impact in pre-retirement, because the more money that you can put away in your different retirement buckets, and the more that you can safeguard those retirement assets from any stock market volatility, the better off you're going to be at time of retirement and then for many, many more years to come. But once you're in retirement, there's another major impact to your longevity planning or the risk of living too long, and that is the sequencing of returns, meaning that, while you're employed and you're putting money away into your retirement plans, when the market goes up or down, obviously you feel the pain a little bit, but it's not as painful as when you get to retirement. Because while you're employed, you can allow your assets to recover from a market downshift, like it did in 2008, or maybe even going further back to 2003, and some of the other issues and all the market corrections that we have had over the last 20 years. But because of the fact that you were employed and you didn't need to have access to those funds while you were employed, and then you did have the option to allow your money to little by little recover every single year. Once you're in retirement, the rules of engagement totally change. And the rules of engagement totally change because now you have gone from people at work to money at work. And now, regardless whether the market did well for you one year or did bad for you on another year, you still have to dip into those accounts in order to maintain your standard of living. So if the market goes down on any given year, so the market goes down for 2 or 3 years in a row, not only are you depleting your assets because of the reduction and the loss of assets due to the market volatility, but you're also depleting your assets because of the fact that you need to invade those assets in order to maintain your standard of living. So that becomes a major issue to consider and things that you need to prepare to in order to mitigate that risk. Now, interest rate risk is the same thing. I remember back in the 1990s, I had a number of clients that retired and, they had, let's say, $1 million portfolio. Back then, if you invested in a CD, you were able to get anywhere between, 5.5% and 6% on a CD. So on $1 million portfolio, you were able to generate anywhere between $55,000 and $60,000 in retirement income without having to invade principal. Well, try to do that in an interest rate environment that we're living today. You can barely do $20,000 of income, let alone $55,000 to $60,000. So if you're in that kind of an environment in retirement, you may have no choice but to start to deplete your principal in order to make certain that you can maintain your standard of living. Another area that you need to consider when it comes to the risk of living too long is healthcare risk. And yes, we're going to be actually next week, we're going to talk about the 4 ways to mitigate the risk of living with a disability. So, healthcare will become a major problem for all of us and a major consideration for all of us in retirement. And the reason for that is simple. What used to kill, especially Americans, 30, 35, 40 years ago, is no longer killing us. Now, that means that it is no longer killing us, but it could leave us disabled. And the longer you live, the larger the susceptibility to become disabled in retirement. As a matter of fact, if you're age 65 today, husband and wife, fairly healthy, there's a 75% probability that one of you is going to have a need for long-term care. And long-term care has become extremely expensive and will continue to become more and more expensive as time goes by. By the same token, now you need to prepare because now you're going to have to offset those additional medical expenses. So that becomes a major detrimental factor in making it to the end of your life with income. Because, one of the things that I share with all my clients is that if getting old is bad, getting old and running out of money is even worse. So you never want to run out of money before you run out of life. So that's another major consideration. Opportunity cost risk. This is one that none of my clients, whenever they come visit with me for the first time, have ever considered. An opportunity risk happens primarily when you're purchasing very large items like homes, automobiles, gadgets, of some kind. And the opportunity cost is that, in every purchase that you make in the United States, there's an opportunity cost, meaning that the money that you're earmarking or you're spending on one side of the ledger is failing to either purchase something else or work on your behalf on the other side. Let me give you a simple example. Let's say that you are purchasing a $60,000 automobile. And let's say that had you not purchased that automobile, you could have had that $60,000 growing on an account on your behalf, and let's say earning an average of 5% per year. So fast forward 30 years from now, the $60,000 growing at a 5% interest compounding on an annual basis would be equal to $259,000. That's an enormous amount of money just for the purchase of one vehicle. Now, if you now deduct the original principal of $60,000, then that means that $60,000 could have earned an additional $199,000 in change on your behalf. So the opportunity cost of having purchased that automobile represented an opportunity cost of $199,000. Now, obviously, we all understand that you have to, have automobiles unless you happen to live in a major metropolitan city like, let's say Boston or New York, where, many of my friends or clients that live over there, they haven't driven a car in many, many years because public transportation, it's very, very good for them. So there's no need for them to enter into that additional expense. But for those of us that don't live in major metropolitan cities, then you need to have an automobile. The question is, well, what if instead of buying a $60,000 automobile, I buy a $30,000 automobile? Yes, it'll take me, both cars are going to take me from point A to point B, regardless of, whether I pay $30,000 or $60,000. But the point that I'm making here is if you pay attention to the purchases, then by acquiring a $30,000 automobile, then at least you're saving $30,000 that now can compound at 5% for many, many years. Now, the other issue is that instead of having to buy a car, and by the way, this exercise also applies if you're leasing an automobile, but if you're buying a car every 3 to 4, maybe every 5 years, well, take care of your vehicles. Buy one every 10 years. So now you have that opportunity cost working on your side of the ledger instead of working against you. The other point that I want to share with all of you, and this is a consideration that I engage all of my clients with on a regular basis, is the fact that everything in this country is financed. Either you pay interest to someone else, or you fail to receive interest on your money by paying cash. Because some of the feedback that I get from clients is, well, Bert, I never finance everything. I pay cash for everything. Well, I just showed you in this exercise that everything is financed. Because if you paid cash, if you paid $60,000 in cash for that vehicle that you just purchased, then you are no longer earning that 5% on that $60,000. So either you pay up or you fail to receive interest. Either you pay interest to someone else or you fail to receive interest on your money by paying cash. So we'll get into more of those issues when we get to the episode on living with eroding factors and how to mitigate those. The other thing that you need to consider is what I call the life happens risk. Life happens, and there are many things that are totally unexpected that all of us are going to have to deal with in retirement. Children, grandchildren, divorce, propensity to consume. One of our children gets sick while we're in retirement. Now we have to, go ahead and dip into more of our assets in order to help our children deal with their issues and concerns. Well, our grandchild can get sick, and obviously those are things that we care and love very, very much. So life happens, and you need to be prepared for those things that life is going to be throwing at you as you move through your life. Also consider that there are 3 stages of retirement, and I call these stages the go-go years, the slow-go years, and the no-go years. So between the ages of 65 and 75, if you're a traditional person that retired at age 75, most of us are fairly healthy. So you're going to be on your go-go years. You're going to be spending, perhaps many times more money in the first 10 years of retirement than you did prior to retirement, because now you want to catch up. You want to catch up to the things in life that you had postponed because you were working so hard to maintain the standard of living of yourself, your family, and many of you, your business. So the first 10 years are your go-go years. Now, once you hit your mid-70s, let's say 75 to 85, you go into the stage of what I call the slow-go years. You're not going to be traveling as much. If you're traveling, you're going to stay closer to home as opposed to traveling outside the United States as you did during the go-go years. Now you may want to spend more time with your grandchildren, but you're still spending money. But the money that you spend during the go-go years, you're not saving now because now you enter into the slow-go years. So a lot of that money that you ended up spending during your go-go years are now being spent in healthcare issues and concerns during your slow-go years. And then last but not least, once you get into your mid-80s until the day that you die, that's what I call the no-go years. So you have to be very candid. You have to be very flexible. You have to understand that there are different assets that are going to be fitting in the 3 stages of life in between the go-go years, the slow-go years, and the no-go years. The final area to understand here when it comes to retirement, by the way, I can spend 3 hours just understanding the risks of living too long, but is what I call the what ifs. What if you didn't save enough? What if your income in retirement is not sufficient to meet your expenses? What are some of the things that you can do? Are there any risk transfer techniques that can be utilized in order to mitigate those issues and concerns? Well, the answer is yes. But the vast majority of clients that I meet for the first time are not fully aware of how they can mitigate those issues and be able to live a comfortable life, even if they were not able to save as much as they intended to during their employment years. Part 2 here, or out of the 4 ways, so part 2 of the ways to mitigate the risk of living too long would be, optimum contributions to taxable and the tax-deferred buckets. So here, what I just said, optimum contributions to the taxable and tax-deferred buckets. Now, I didn't say maximum. I said optimum contributions. And the reason for that is that because the taxable bucket and the tax-deferred bucket, as we covered during the past 3 weeks in the other series that we covered on the taxable buckets, because of the fact that there's taxation, there's an erosion happening to your assets in the taxable bucket and the tax-deferred bucket, which is the tax erosion. then you need to know exactly how much money you need to contribute to the taxable bucket and the tax deferred bucket. Whenever we do an audit for a client, we find out that they're contributing way too much money to the taxable bucket or the tax deferred bucket. So you need to have the optimum amount of money in those two buckets in order to reduce and or minimize and or eliminate your tax liabilities in retirement. So in the taxable bucket, obviously 3 to 6 months you should have there to cover emergencies and or opportunities. And we did spend quite a bit of time in going through the taxable bucket in the previous few weeks. So feel free to go back to that episode and review it again. The tax deferred bucket, which is the bucket that most of us understand on the pros, but very few of us understand on the cons. And by the way, just go back and listen to that episode again. Obviously, you need to be able to do net present value calculations in order to determine what is the optimum amount of money that you should keep in your 401ks, IRAs, 403bs, pensions, deferred compensation programs, and so forth, because unless you're able to have just the optimum amount of money in the tax deferred bucket, then you're going to create many other problems for yourself and your family. Number one, everything coming out of that bucket will be fully taxable at future tax rates. Remember, when you put money into the tax deferred bucket, you're not saving on taxes. You're postponing taxes. And when you postpone the tax, you also postpone the tax liability. So there's a very high probability that taxes are going to be a lot higher in retirement. So therefore, having the optimum amount will allow you to avoid many of those taxes. And by the way, if you have too much money in that bucket, you're also creating a detriment to your Social Security benefits, because up to 85% of your Social Security benefits may be taxable in retirement if you don't do a good job in managing your taxable bucket and your tax deferred bucket. Most important, even your Medicare premiums in retirement can be negatively impacted by having too much money in your tax deferred bucket and your taxable bucket as well. Point number three, number three way of mitigating the risk of living too long is maximum contributions to the tax-free bucket. Why? Because the tax-free bucket, the money that you put in is after tax. The money grows tax deferred, and you pull the money out tax-free. So you're able to maximize, if you're able to maximize the contributions to any one bucket out of the three buckets that we've talked about over the last 3 weeks or so, then I encourage each and every one of you to make the most amount contributions and the most use of your tax-free bucket than any other bucket under the IRS code. And that would be your Roth IRA's contributions, your Roth 401k contributions, and your 7702 plans. By the way, just so you'll know, the wealthy cannot invest into Roth IRAs along those lines. So usually the wealthy have a tendency to invest loads and loads of money into 7702 plans, which are cash value life insurance plans that enjoy some of the biggest benefits under the tax code that this country has ever put together. So if you truly understand how 7702 plans, then you would make certain to make them part of your tax-free bucket. Now, you notice that although municipal bond funds fit into the tax-free bucket, I don't consider municipal bond funds a total tax-exempt product. Why? Because although municipal bond funds come in federal income tax-free to you, they do get added on to the provisional income calculations in order to determine what percentage of your Social Security benefits would be taxed in retirement. And also, they have a negative impact on the Medicare premium that you will pay on an annual basis. Most important, there are many times where out of the municipal bond funds, you may have to pay state income taxes and also capital gains taxes. So, whenever we engage into the tax-free bucket, and we're not going to talk about this today because we already covered that last week when we discussed the pros and cons of the tax-free bucket, but this is one of the areas where I always try to make certain that my clients understand exactly how the buckets work and what it is that they can do in order to mitigate the tax liability in the future. So, the 4 ways to mitigate the risk of living too long, we've talked about. Number 1 way is to understand the risk. Number 2 is making optimum contributions to the taxable and the tax-deferred buckets. Number 3, to make maximum contributions to the tax-free bucket, and also understanding that certain assets in your tax-free bucket, or actually certain assets in your entire retirement portfolio, should have guaranteed income for life. You need to be able to create private pensions to meet fixed and variable expenses in the future. Now, I deal with a lot of retirees because I am a retirement strategist. And whenever I interview a retiree, one of the feedback I always get from them is that if they were given a choice between having less guaranteed income in retirement or more guaranteed income in retirement, 100% of the time they choose having more guaranteed income. Now, if you happen to be a lucky American and you work in a company that provides a pension in the private sector, or you happen to be a public employee that will provide a public pension system, then obviously you're on what I would consider to be the top 1% of the food chain, because of the fact that, the vast majority of Americans don't have a guaranteed pension. Now, Social Security is also a guaranteed pension, at least, for those of us that are close to retirement that have no clue what's going to happen with that, for the new generation that is currently working, because as you know, Social Security is a pay-as-you-go system. So those of us that are working today, we're actually paying for those that are already retired. But if you do have the ability to create private pensions, and there are products that would allow you the ability to do that, then you would be in a much, much better position than if you don't have the ability to have certain private pensions on your side of the ledger. And then number 4 is, the big difference between ordinary income versus capital gains. In a perfect world, you want to be in a 0% tax bracket, because if taxes were to double in the future, 2 times 0 is still 0. So, I would rather have all of my clients at the 0% tax bracket. But sometimes, and depending on the assets that the clients have, we may not be able to do so, but at least we want to be able to get their effective tax rate to single digits as much as possible. But if I'm going to have to pay taxes in the United States of America today, I rather pay the taxes based on capital gains than ordinary income. And the reason for that is that if you're a middle-class American, there's a very high probability that your capital gains are going to be either at a 0% or 15%. Most of the time, whenever I ask a question as to, what are the taxes on capital gains, everybody says 20%, and that's not the case. Yes, 20% is the highest marginal rate where capital gains are going to be taxed, but there are very, very few Americans who will ever invade that 20% capital gain tax payment that would have to be made. So the vast majority of the clients that I deal with, they're somewhere between 0 and 15%. And when you do the effective tax rate, many times, capital gains are somewhere between 5 and 7%. Now compare that to the average of 22% on ordinary income. I would take capital gains every single day of the week. Now the question is, well, how do you get your assets to produce or be taxed at capital gains rate? And there are a number of things that you can do. And obviously, not everyone has the ability to do this, although all of us can do it at any point in time. Number one, start investing in real estate. Because even if you generate real estate passive income, let's say you're receiving cash flow income on your real estate properties, whether you own a duplex or a single family home that you have rented out, or you have a small apartment building. A number of my clients own small apartment buildings anywhere between 8 and 12 units. Then obviously, even if you're receiving passive income, then you do receive certain tax benefits and deduction that will reduce that taxable income that you would have on a monthly basis significantly for you and your family. Also, real estate capital gains treatment. That means that if you decide to sell a piece of property and you have a gain in that property, that gain, as long as you had it for at least a year and 1 day, now will be treated as a capital gain and is going to be taxed at a much lower rate than if it would have been treated as in ordinary income if you sold that property in less than a year. So now you're receiving an additional tax rate along those lines. 1031 exchanges. That means that if you sell a piece of property at a gain and you don't want to pay taxes on that gain immediately, then the IRS, under the 1031 rules, allow you to transfer that gain to another property that you acquire and allow that capital gain to continue to grow on a tax deferred basis on your behalf. And the key to, using real estate as a way to minimize your tax liabilities in retirement is that it will provide monthly cash flow. And that monthly cash flow, depending on what type of property you own, it can be construed pretty much as a guaranteed cash flow. Now, obviously, tenants may leave and they need to be replaced and so forth. But for the most part, you can use that cash flow on a monthly basis and consider it to be a partial guarantee to a guaranteed cash flow. So again, understanding the risk, optimum contributions to taxable and tax-deferred buckets, maximum contributions to the tax-free bucket, and last but not least, understanding the difference between ordinary income and capital gains will give you the ability to mitigate the risk of living too long, which, if you happen to be healthy, that's a very good world to be living in. My final thoughts are very simple to all of you. One of the things that we do in our firm very well is that we create customized tax-preferred retirement blueprints for our clients, and having a tax-preferred retirement blueprint is a must if you want to be able to mitigate the 4 risks that we've talked about, the risk of living too long, living with a disability, living with eroding factors, and the risk of dying too soon, which we will cover over the next 3 weeks. But unless you have a blueprint in place, you're not going to be able to mitigate any of those risks. And by the way, if you have the ability to mitigate those risks that we're going to be discussing over the next 4 weeks, and you're going to be able, and if you're able to do so, then you're going to be in a much, much better position than just about every American you come across to. Because a vast majority of Americans, when they start to think about retirement planning, they never look at retirement planning from a risk management perspective. So having a tax-preferred retirement blueprint is paramount if you want to have a successful retirement life. Now, I also encourage you to use and utilize the expertise of a retirement strategist and or tax planner. And I happen to be one of them. My specialty is retirement distribution planning and tax planning. So if you want to engage me and have a conversation with me, if you like this episode and you like to have a conversation with me at no cost or obligation, we can schedule a 30-minute either phone call or a video conference. I love video conferences because we can see each other over the internet, and you can ask me any questions that you have concerning your retirement and issues and kind of financial issues that you may be dealing with at this point in time. Now, if you want to exercise your ability to contact me, feel free to call me, please. My number is 786-766-1042. You can also email me if you wish at Bert, B-E-R-T, at GablesTaxGroup.com, and I will be more than happy to schedule a 30-minute conference call with you and answer any questions that you may have. But most important, determine if a customized tax-preferred retirement blueprint may be suitable for you, your family, and your business. And last, I always like to close with this statement because I think it's apropos every time that we do a podcast. And this is, by the way, episode 61. We've already done 61 podcasts, so I'm excited about this. And we will continue to do these podcasts on a weekly basis for as long as I have air in my lungs, and as long as I'm healthy, I want to continue to help each and every one of you. By the way, whether you do business with me or not, because at the end of the day, I have been very, very fortunate in the business that I do, because the more times I help my clients and the more times I help people that join me for seminars and webinars and podcasts, the better off I do for myself and my family. So it always comes back 180 degrees. So again, my closing statement and again, my number one goal for each and every one of you is to kind of help you and your families change the way that you do things and the way that you see things. Because when you change the way that you do things and the way that you see things, the things that you do and see change. So again, thanks very much for giving me a few minutes of your time today, and I look forward to speaking to you again next week. Have a great day. Take care.